Okay, I'll just check that you guys can hear all right. Does this sound okay over here? Good. What about you guys up there? You're good? You guys are good? And I presume you guys are good? Right, let me just wait for that last minute for them to click over. All right, we'll make a start. So today we move into the final one-third of the course, which is around the financial institutions, and we're going to start with the regulation of them. But this sort of ties together some of the two previous pieces of the course that we've talked about. Initially, we sort of talked about how interest rates get set and so on, and how that directly influences values of things in markets. Then we talked about the 5 markets that we cover in this course, and then the institutions themselves are, they often work in those markets on behalf of their clients, such as the depositors. Now, next week is the 4th online quiz, and the subject matter of that quiz will be up until the end of this topic. So basically from the overview through to the end of the regulation of financial instruments, institutions. But I'll give you more details on exactly what they'll cover on Friday, but this topic is included in that final quiz. So this is an outline of what we're going to do. We're going to talk about, give some introduction to this topic, and then we're going to look at why banks fail. And it's fair to say that when you look at how countries have fared over the years, usually what happens with a country is it starts off as relatively undeveloped. It has problems managing itself. Often it have a sovereign default in which the government itself defaults on its debt. But ultimately, many countries graduate or move out of that phase, and they become stable, and they become, they don't default on their debts, and they go on, and they become very prosperous. But so far in history, no country has been able to move itself out of having bank failures. So bank failures are quite different. They're still persistent, and even countries that like to think of themselves as being extremely advanced, like the United Kingdom and the United States, they have bank failures even now. And New Zealand is not immune to them. We've had bank failures before. In fact, the Bank of New Zealand was sold to Australia simply because it basically gone bankrupt, and the government sort of bailed it out and then sold it off. So bank failures are still with us, and what we're going to look at is why they fail, and it has to do with the structure of the business that they are running, and it really doesn't have anything to do with either illegal or unethical behavior on the part of the people running the banks. And then we'll look at the methods that they use to supervise these things. Remember, we started off in the early part of the course talking about prudential regulation and the prudential regulator. So this is where it's actually put into use, because prudential supervision is essentially looking at the risk-taking today to try to ensure stability going on into the future. So we'll look at their methods, how they do it, and various controls that they have. So introduction. When you think about a deposit that you might make at a bank, you say, well, if I put my money in a bank, that is actually a type of a loan. So we ask ourselves, what type of loan is it? Now, depending on where you are, but particularly in New Zealand, Australia, and many other countries, if you put your money in a bank, it is an unsecured loan. So in the event that the bank fails, then you're an unsecured creditor, and the receiver comes in, the receiver tries to recover value. Most of that value will be in the loan book. But it will take time and effort on part of the receiver to recover the value and then to pay out those who are creditors. And unsecured creditors get paid out after all secured creditors get paid out. So if you're a depositor, you often have to wait a long time in these situations to get any money out of them. Now, some places this is not the case. It's still unsecured, but they have a different mechanism for dealing with it. In the United States, they have deposit insurance, and there's various countries, other countries that have a deposit insurance. And in that situation, what happens is that the banks themselves pay an insurance premium to a federally owned incorporation, and that is their insurance premium. And if they fail, then the Federal Deposit Insurance Corporation pays out on the losses. And this makes dealing with bank failures quite simple. In the United States, when a bank fails, often what they have what they call is a Friday night raid. The bank will close its doors for business on a Friday night. It has technically failed already by that point. The regulators will come in Friday night, and over the weekend they'll work with both the bank that has failed and someone they've lined up to take it over. And on Monday morning, the bank will reopen and everything will just continue on as per normal, except the bank is now owned by some other corporate, usually another bank takes it over. But a deposit and service makes things very simple to deal with. Now here, that's not the case. If they do fail, or not just the bank, but other types of financial institutions fail, then people lose money. And we had a lot of failures in our finance company sector in the mid-2000s, and it was unsecured lending. Receiver had to come in, recover value, and sometimes it was years before people were paid out. And although a significant amount of value is recovered, typically recovered by the receiver, there were some losses there as well as long periods of time before they got their money back. And so in these sort of situations, what we really want is some mechanism to at least try to stop this thing happening in the first place, and maybe, if it does happen, an easier way to deal with it. So when we look at what's in this chapter and what's in this topic, we're really going to look at understanding first the problems that there are in maintaining the safety in these financial institutions, and then what regulations, what other mechanisms are put in place to try to prevent these failures. And it's fair to say that the Australians have done this very well in recent times, and because most of our financial institutions are Australian-owned, we've benefited from them. So when you look at the banks and the other financial institutions like finance companies, insurance companies, and so on, they actually form a really important part of the economy. And so if you get a failure in one of these, you usually end up with major problems in the economy. And it's not uncommon to see, for example, a bank failure and get either a recession, directly result of bank failure, or sometimes if you get multiple bank failures, you can get a depression. And there's a lot of things that goes on. There are various reasons why it takes off in that way, and we'll come to some of those. But when you're thinking about the bank's business, there is risk involved there, and there's simply no way to actually remove all of this risk. So there are two conflicting sets of requirements in terms of this risk. One is there are owners of the bank. Many banks are privately owned, and so what the banks are trying to do, the managers in the place, the board of directors, senior managers, and so on, they're trying to maximize the return of that bank for the shareholders. And you cannot increase your return without wisely taking on risk, but there's no way to do that without taking on risk. You can't take on risk willy-nilly. You have to assess it very well, take on risks that are worth taking and avoid those that are not, but there's simply no way around taking risk. So you have one set of demands there. You have to push that risk up to get those rewards, but on the other side, the governments, and particularly through the regulatory agencies which they've created, they're concerned about this risk that is being taken as a normal part of the business of the bank or other financial institution versus the safety of that financial institution, because a failure is going to be a big problem. Now, in thinking about the development of the financial system over time, one of the things we've said before, and it's quite true here, is that most of the changes in the financial system, and particularly from a regulatory and legislative point of view, is to do with major problems, major crises. And of those crises, banking crises are certainly the most common, and they've been the big driver of changes. So here's the main point, what they're trying to do with these things. We're trying to create a framework which will avoid the problems we've seen in the past. Now, because you cannot see the future as well, sometimes the very fact that you put responses into it will actually change the behavior of the banks, and they'll create new problems, which then calls for another response to deal with that problem that's cropped up. Okay, so let's look at this question. Maybe we'll start with the question, why do we have regulation of financial institutions? If you think about how much regulation there is put on financial institutions, it's quite large. If you take a different type of business, say a software developer, there's not a lot of regulation around software development. Why is there this difference? Why do we regulate financial institutions to the extent that we do? What is it trying to achieve? Consumer protection is one reason. That's what it's trying to, at the end, it's trying to achieve consumer protection. Okay, so that's an end goal. Anything else as to why we have it or what we want to do?
Generate and disseminate all the information.
Okay, so we say generate and disseminate information. Now, one of the problems with this is that within these types of financial institutions, information asymmetry is just the norm of business. So there's three things. One is this one here, which is just mentioned, that asymmetric information. Now, you say, where does this come from? Why is this just inherent in the type of business that's being run? And basically the problem is this. If you want to get a service from a financial provider, say you want to, for example, you want to have a loan from a bank, you go in there and you provide them a whole lot of financial data about yourself. You know, if you're a family, you provide your income, what your expenditures are, what assets you have, on and on and on, and then the financial institution will make a decision whether they're going to grant you that loan or not. And that's just a normal way, part of doing business. But that information that you have given them is then held in confidence. Okay. So what this means for someone who is a depositor at the bank, you may know that in general, the strength of the bank depends on the quality of the loans that it's made, but you don't have any other information on who they've made these loans to. So, A, you don't have that information, but even if they gave it to you, most people would not know how to assess this to work out how safe their bank was. So this problem of information asymmetry is just inherent in the nature of the banking industry and also inherent in the nature of the other financial institutions that we're going to deal with. So the second bullet point there, regulation, we said this before, but we'll say it again because it's quite an important point. It's a mechanism for trust without personal verification. So if the regulator does its job right, you can trust your bank. You do not have to go and personally verify that your bank is sound. And the various ways they do it, they've got regulations. Regulators usually are empowered under some sort of legislation to create regulation as necessary, but they impose uniform regulations pretty much across the entire sector. So if it's the life insurance sector, all life insurance companies are subject to the same regulation. And it's the reliance on these regulations is the thing that really allows us to replace our individual verification and our trust with trust in the regulator. And so that ends up with the, having the benefits for us. Now, any other points we should make about what we're trying to achieve with these things, regulations? Yeah, go ahead.
I guess by regulating certain, financial intermediaries, because if one collapses, it'll spread to the whole economy.
Okay, so there's a problem, that specific problem of if one intermediary falls over and collapses in some way, that it then affects the entire economy. That's called contagion. And that's a very serious problem, and it's one of the things that the regulators have to deal with, and we'll talk a bit about contagion a bit further on. That's a real serious problem, because often all it takes is one failure, and then you have a lot of trouble, not just within the sector itself, but outside the sector as well. Anything else? Okay, there's one more point here, probably, at least. This one here, this depends a lot on where you sit in terms of the political spectrum, but the power to allocate credit, which is basically what banks and finance companies do, it's very valuable. And often governments themselves want to actually have some say in this. And the way they have a say in it often is simply by, putting regulators in place. In some cases, they actually own banks. Another financial system, there to actually be a state-owned one. But it depends a lot on where you are in the political spectrum, how much you think this should be done. If you're in a very interventionist, left-wing view, you tend to think the government should intervene a lot more than if you're down the less interventionist viewpoint. So let's see. Yeah, perhaps we should make this point here that this was about the contagion. It's very easy to see how this happens if something happens. So say a bank goes under, because it's unsecured, people have immediate loss of access to their deposits. So money they counted on being able to pull out as needed, they don't have access to that. If you want to get a loan from that institution and it's now defunct, you have to go to another one. Often it takes time to develop a relationship with a financial institution to the point where you're a regular customer and you get credit. So switching over takes time, and while you don't have access to that credit as a business, your business suffers. Yep, said those things. Right. Okay, any point on that we want to ask before we go on to the bank failures themselves? Okay, now we'll look at bank failures, why they actually fail. So there's two reasons why they fail. What are they? How do they make a bank fail?
Take too much risk.
Take too much risk. What does that actually do in terms of the mechanics of when a bank goes failure? What is the mechanism from too much risk to failure? Yep, go ahead. Okay, so the core issue there is that one way they could fail is become insolvent. Your point, they take too much risk. This tends to means they take too much risk in their loan portfolios and they're not getting adequate return for that. And if that risk comes to bite them and the loan portfolio loses value, that gets written off against their capital, and we'll come fairly soon to what that capital is. And then if you get a big enough drop in the loan book, what you end up with is that your liabilities are larger than your assets. Bank is insolvent. Business is over. So that's one of the risks that they have. What's the other way they can fail? Yeah, go ahead.
They have insufficient liquidity on hand, so they're still technically solvent, but they can't pay their debts today, so they fail.
Yeah, so the second one is illiquidity. They may be solvent, they may be profitable, but if they don't have enough liquidity on hand, then the business fails. That can be something like if someone sends them a bill for rent and they don't pay that bill because they don't have liquidity, or something like you go to withdraw money and it says no money here because we're out of liquidity. In both cases, what happens is the bank fails. If it cannot particularly meet withdrawals, loan drawdowns, and that sort of thing, if they can't meet that because of illiquidity, they're out of business. Now, in reality, often one leads to the other. So there are actually two ones. But often what we find, I added this today, if you get in a situation that you're illiquid as a bank, that can rapidly lead you to insolvency. So how does that happen? How can illiquidity on its own push you very quickly towards insolvency? Oh, yeah, go ahead.
If you have to sell assets below their value in order to quickly generate the cash to cover your liquidity needs, then you could eventually become insolvent that way.
Okay, so the key point there is that to generate liquidity, to get liquidity back onto your balance sheet, you're going to have to sell some of these illiquid assets. To do that, typically you have to sell them at below what their fair price would be if you had plenty of time to sell them. So what you're doing to generate liquidity, you're taking losses on your assets, and if this happens enough, or the discounts are high enough, you start losing capital, you run out of capital, you're insolvent. And we certainly saw that in the financial crisis. I think I put it in one of the earlier sections that when, particularly in Great Britain, when banks went to their regulator, their central bank, Bank of England, asked for liquidity, sometimes they were discounting those assets by as much as 60%. So if you have a discount of 60%, that discount chunk goes out of your capital. You don't have to do that too many times with too much assets before you actually run out of capital, and then you're insolvent. So typical examples of why, if people draw out money too fast, then they run out of liquidity. People who are taking down loans, if they can't take out a loan, actually can't draw it down, they end up, bank ends up illiquid. Now, this sort of problem, at least in theory, is preventable. And so the regulators, one of the key jobs of regulators when they're actually looking at institutions and imposing regulation on and monitoring their behavior is to look at how are they managing their liquidity, do they have enough, or do we have to go and make them have more? So the job of the regulator, one of the key things is monitoring the liquidity of the banks. And in the case that they're financially sound, and they collect financial information on these banks on a regular basis. If there's only a problem with liquidity, we have a lender of last resort which can step in and provide liquidity as necessary. Probably not much more to say there. Okay, so move on. So the other one is, as we mentioned, you get losses on your assets, particularly loan defaults or loss of value, then your capital goes away, and if you lose too much of it, you can become insolvent. Now, we're going to come to exactly how much capital they have, exactly what it is, how much they have, but it's fair to say that in general, if you take a New Zealand bank or Australian bank, if they lost about 7% or so on their asset side, they would become insolvent. It doesn't take much. So the basic structure of these things, and we'll look exactly how the structure is, they have a little bit of capital, a huge amount of debt, and they use that to finance their assets. And so that tiny bit of capital that they have, typically 7% or thereabouts, it only takes a small loss on the asset side to completely wipe that out, and they're insolvent. So there are international standards which set how much capital you have to have, and they're known as the Basel Accords. There have been 3 of them so far, and both New Zealand and Australia are on Basel III. That's the most recent ones. And one of the key things we're going to talk about is that it's not just capital versus assets. They actually risk weight these things, risk weight the assets. And so that makes the calculation of how much capital you need a bit more complicated than if it was just against the assets in total. Okay, any questions on that before we go to contagion? Okay, contagion. So what is contagion? We said what it was just a few minutes ago. What was it? What was it? What is it? Yeah, go ahead.
When problems in one institution spread to the rest of the financial system.
Yeah, so a problem in a single institution can spread out through the entire system. So basically, one problem here, pretty soon, other financial institutions have a problem. Those will in turn generate more problems, and very quickly, often in less than a day or two, the entire financial system can be in trouble. Very quickly, the entire economy is in trouble. So, in terms of a regulator, from a regulator's point of view, was charged with overseeing the system, what sort of problem or problems does this type of problem particularly pose to them? How on earth are they going to deal with this? What is the problem that they have to deal with? And the fact that one institution can affect a whole lot.
They have to focus on the frequent rather than
Okay, so in terms of actual pragmatic response, I mean, the focus has got to be on prevention, and the whole system of regulation is around prevention rather than cure. But to do prevention properly, you have to assess this risk. So there's some specific problems with assessing this risk. Yep.
Since the risk isn't just separated per like bank, then have to analyze the risk of the whole economy or how they're all linked.
Yeah, so this is where it becomes the real problem they have is that because a problem in one bank will propagate to the rest of the system, you have to understand the system as a whole and not the bunch of banks as a bunch of pieces. Okay, so when they're assessing a bank, there's going to be at least two things going to have to look at. They have to look at the bank itself, but then they also have to look at the bank in terms of the context of the larger system and ask the question, well, if this one bank here or life insurance company or whatever it is, if this one fails, how will this propagate through the system? And that, understanding that is actually very hard, very hard. And so far, even though a number of central banks have put a lot of effort in trying to understand this problem, there's certainly, the understanding of this problem is not very good at the moment. So trying to work out what the effect will be, we don't have good models of this. So it's a real problem here. This is an area which definitely needs more work to make this better. So I've said that. Said that one as well, last one. So let's. Any question on this before we move on to the next one? Contagion is quite a problem. Questions? No questions. So now we're going to look at the methods that they use to actually supervise these institutions. So the Australian Prudential Regulation Authority has got these two things they call PAIRS and SOARS, which are their two key tools for analyzing both financial institutions and this big problem of contagion. So what are they? What's PAIRS or SOARS or both within their role as a regulator? Oh, yes, go ahead. Okay, so the P in PAIRS is probability. What it stands for is probability and impact reporting system. And so the probability that they're interested in is what is the probability that this financial institution will fail? And the I is the impact. So there's the two components we talked about before. The P, probability, is about the institution itself. The I, the impact, is really around the contagion thing. So P, will it fail? I, what impact, what does it do in terms of contagion for the rest of the system? What about the SOARS? Anyone know what SOARS is? Okay, let's move on. No one knows. Right. So there's actually a little bit more generality to this. There are these two ones, and these are the ones we're going to cover now, but there's two more things that they do as far as regulators. One is they look at the entire industry. They're looking at an industry-wide risk analysis, and that's essentially trying to understand this problem of contagion before it actually happens. So it's not just looking at individual institutions, it's looking at the system as a whole. And then the other thing that they do is, if they uncover a problem, hopefully they don't, hopefully everything is fine, but if they uncover a problem, then they actually got to put some plan in place to fix the problem, and they need these plans ready to go before they actually need them. So the PAIRS, which stands for Probability and Impact Reporting System, there it is. Probability that the regulated institution will fail. So this is the institutional level assessment. And hopefully this is so close to zero that you don't have to worry about it. That's what we want. Now, it's not always the case, but that's what we like. And then the I, how it will affect the entire system, that's our contagion problem. And then the second part, the supervisory oversight and response system, that's what SOAR stands for, is the thing that they use to then decide what they're going to do. So what they do is pairs first on an institution, and then when pairs is finished and has an output in terms of a rating, that goes over into SOARs, and that determines what they do in terms of the supervision. So pairs first, output of pairs feeds into the SOARs part of it. So when we're looking at why an institution might fail, because this is what you're going to need to look at if you're going to work out a probability, there's just risk, risk in relation to its business operations. And as I said before, this is just the normal business risk that is taken in running a financial institution. This is not unethical or illegal behavior. This is just normal risk taking that is an essential part of the business. They look at the management, how well they have risk management controls in place, and then there are plenty of things you can do to reduce your risk, but even after doing as much management of that risk as you can, you're going to end up with net risk. You simply cannot eliminate all the risks that are there in this type of business, but you can do things to try to mitigate them. And then the final thing is they look at how much capital you got in case there are problems and these risks come home. So this is the 12 things they look at when they're going to the individual institution. And these fall naturally into three groups. So there's a group here. And this is basically all around the management of risk. And that's just normal business risk. So the board of directors, your senior managers within the institution, whether it has risk government policies and risk government sectors, and then there's any strategy you have as an institution, any planning you've done around these types of risks that you face, all that is humans managing the risks that are there in the bank or other financial institution. And a number of our graduates over the years have gone into the third one of those, the risk governance. A number of graduates have got positions as risk managers in various financial institutions, and that becomes their day-to-day job, is to assess risk within their institution and report on that for further management. The second group of them, which runs down to down here, you can sort of tell them because they're all listed as a risk. This is the risk that you have because you are in this business. This is just the risk that's there because you choose to be a bank and not something else. And so your insurance risk, operational risk, because operational risk, you can have things like failure in your computer systems, you can have rogue traders and all that sort of stuff. Liquidity risk, which we're talking about, market investment risk, if you have investments in, say, money markets or bonds and so on. That sort of risk is what you have there. Credit risk, if you're making loans as a bank does, the fact that some of those people will default over time. And this is just the risk that is simply there because you choose to be in this business. And then the final piece there is basically the protections. So the capital is key one. Regulators look very close at the capital, and we'll come to exactly how they measure it, what that is fairly soon. They look at your earnings, how profitable you are as a bank, and all the people always get very jumpy about banks making a lot of money. What we really want is banks to be sound, and that does require them to be very profitable. So you look at their earnings, and the final thing is, if things got tough, how quickly could they get additional capital? Because that varies from institution to institution. Some of them will find it very easy to raise additional capital. Others will find it quite hard. And that affects how likely you think this bank is to fail. Because if it starts to lose money but can recapitalize quite quickly, it's much less likely to fail than if it starts to lose capital and cannot recapitalize quickly. And that varies a lot from bank to bank. So those are the three groups of 12 factors that they look at. Now, the second part of it, does anyone want to ask a question about that bit before we go to the impact business? Yep, go ahead.
Would foreign exchange risk be separated?
Yeah, that would be a market and investment risk one, foreign exchange. So for a bank, which is a foreign exchange dealer, most of the big banks are, that's in a market and investment risk. Yeah, definitely a risk there. Any other questions? Okay. So the second part of the pairs, the impact, is how you figure out how this may, in the event that there is a failure, what impact will this bank or other financial institution have on the rest of the system? And currently, it's pretty crude. It's based solely on the size of the assets. Now, it's fair to say that if you go and look at the APRA's website, they're definitely trying to improve this. But basically, and it's probably not a bad idea, the bigger you are, the harder you fall, And if a big bank fails, you're going to get a lot more, bigger mess than if you have a little bank fail. And trying to actually figure this out in a much more detailed way is truly hard. In fact, a couple of years ago, not a couple of years ago, probably like four years ago, there was a student in the math department that was trying to build a model of contagion, a mathematical model, and solve it. And it was it was kind of sad to see, but it turned out that the problem was so difficult. Even though he could set the problem up, they couldn't actually solve the model. So they couldn't actually figure out what would happen, even though they got the model set up reasonably well. And the guy came over to talk to me about what on earth he could do with these models, seeing how it could not, you could set it up, but it couldn't get it to couldn't get it solved. And although that's at honors level, even when you look at major central banks like European Central Bank, they've been working on this stuff. They really don't have a good idea of how to model the contagion effects. So if you're a good mathematician and you want some interesting maths to do, this is a difficult problem to work at. But anyway, so probably not a bad rule of thumb. Basically, how big is this thing? And then you get categorized as low, medium, high, or extreme based on your size. So once you've done that, once APRA has done that, and they actually have a rating, then that rating gets pushed over into the source system, and it tells them what they should do. So there's 4 levels of response. The first one there is the normal, and if things are normal, then the bank or other institution simply continues to make its disclosures to its regular as it's supposed to, typically on a quarterly basis and so on. And this is where we want things to be. We don't want anything outside normal. Normal is where things should be. As soon as you get problems of any sort, then you start to escalate the response from the regulator. So the next one up, and you can see that at least one problem. All it takes is one problem, and they up their supervision. And it's simply, you think what they're trying to do, they're trying to nip problems in the bud now, deal with problems today so they don't grow into big problems in the future. And so, they step into their oversight mode and try to get this institution back into normal. If it gets worse, okay, next one up is mandated improvement. And if you get into that one, you're starting to get into serious stuff. And APRA, if it's identified problems, they actually demand a formal plan sometimes from the institution about how they're going to solve the problems that they have. Now, they're not out of business yet, but they are legally enforceable. So if APRA gives you a directive on this, mandates your improvement, you can't ignore it. This is legally binding. If you don't do this, then they can take legal action against you. And the final one, which is the bad one, the restructure. And there's 3 things that they can do. They can say you need more capital, and if they go out to the markets and raise capital to recapitalize themselves, they can do that. They have the ability to remove all the senior managers, basically the board directors and some senior managers within the bank, if they think that's where the problem was with the people, they can actually they have the power to remove them. And then if they think things are really bad, they can actually, and this is the common one in the United States when you get a failure, is that the regulator will bring in a new owner. So if a little bank has failed, they'll get a nice big bank to come and buy it for next to nothing, like 1 penny. And they'll take it over. And so this is a common one in the U.S. If there's serious problems, you bring in a new owner, and they take the bank over. And the Australian ones have the ability to do that too. So if there is a failure of some sort, then they can require someone to take it over. Okay, any questions on this to this point? Yep, go ahead.
When this ownership in this bank is listed, then how are you going to take, take all the stocks from the market that is like great ownership?
Yeah, I mean, essentially that is what happens, is that if, when you think about it, if an institution is insolvent, its shares are worth nothing, okay? And so what they might, they typically make a token payment for the shares, but by backing of the regulator, they forcefully acquire the shares at next virtually zero price for them if the institution has failed. So yeah, and of course when you think about, when we've talked about equity, think about where equity people are down the bottom. If there's losses, they're the people who take those losses, and bank goes under, they can have 100% loss. And it's not uncommon to see the bondholders take a hit as well. Bondholders are above that, but often you'll find that the bondholders will have something happen to them. A common one for bondholders is to forcibly require them to convert them to equity, even though there's no conversion clause in their bond. Yep, go ahead.
The other question that you said before that the commercial banks not allowed to invest in junk funds.
Yeah, that's right.
So does that decision just go to the whole bank, or they just said, oh, you're not allowed to do it at all?
Many regulated institutions, in addition to banks, particularly like life insurance companies and so on, some things like that, they are not allowed to invest in the junk bonds. And so this distinction between investment grade and low quality junk bonds, that's written into law, and many regulated institutions are not allowed to invest in this low grade area, and it's simply around controlling risk. And so the bank would certainly be one. Life insurance companies are another common one.
So they didn't go through this whole process to assess that you're not allowed to because this risk is close. They just set up the rules that they're not allowed to.
Yeah, and the rule around not investing in the below investment grade bonds, is something that came out of past crises. And they looked at why did we have this problem. One of the things that created the problem is sometimes that they were investing in junk bonds many years ago now, and they simply said, well, if we stop this activity, say no investment below BBB, then we lower the risk in the system and reduce the probability of failure.
So does that mean if they hold the bonds, if this bonds just degrade like in the future sometime, so they have to sell it?
Oh, you mean like if it started off as an investment grade and got downgraded? Yeah. Unfortunately, that's the case. Yeah, if it goes down into out of investment grade, then you have to divest them. And typically, the regulator will say, you have whatever 28 days or something to do it. Yeah. So yeah, you will have to divest a junk grade bond if it's being downgraded. Okay. Any other questions? Okay. So this is just a brief chart of what the responses are. So this is the probability rating up here. So low, medium, and medium split into two: a low, medium, and low, high, then high and extreme. So that's your probability of failure, and then your impact is on this side. The impact I, low, medium, high, and extreme. And basically, you can see that if you're in the top two categories, high and extreme, if you're not in low, they immediately start looking at you in detail. Now, if you're down here in these two ones, you can get into low, medium probability of failure and still be on normal. But basically, you know, the big institutions, which is really up here, they get onto the problems in those institutions faster than they do if you're down here. So, and it's simply because of the problem of if they failed, they're going to make a bigger problem for the financial system than those small ones. And so they get onto those ones quicker, faster, more severe oversight in any hint of a problem in the big ones. Right, moving on. Okay, so now we're going to talk about liquidity a little bit. Okay, first question there, why is liquidity management important for ADI, and that stands for Authorized Deposit Taking Institution? Why is liquidity management important for them?
This is e-liquidity, but leads to e-so really quickly.
Yeah. So first one, illiquidity on its own puts you out of business. But the second thing is, if you become illiquid, you often end up insolvent, and then you're really out of business. And so, if you think about often how, say something like a bank works, I mean, the provision of liquidity to its depositors and its customers is actual absolute core function of their business. If they cannot provide that, they don't have a business. So if you use your FPOS card, you know, to buy your lunch, and it says, you know, it doesn't say this, but if it did say this, you know, sorry, not today, we're illiquid today, they don't have a business. And of course, that can lead to more serious problems. So, from a regulator's point of view, when they're looking at these institutions, what do they require of them to manage this problem? What do they require for them to manage this problem of potentially going illiquid? Okay, move along. So this is kind of vague as to what this means, but this is the general principle. Liquidity management of the authorized deposit-taking institutions, and there's more than just the bank, aims to ensure that they have sufficient funds to meet their obligations. And that basically means if you want to withdraw money, you can. They can pay the bills on time. Now, they can, you know, the choice of how they do this is quite flexible, but they have to report what they do to the regulator. And it used to be only 5 days, and I think I actually updated this today, so you may have the older ones when it said it was 5 days. But only a few years ago now, only 3 years ago, they looked at this, used to only have to have 5 days worth of liquidity on your balance sheet to meet normal day-to-day functioning of the bank. And they eventually decided that simply was not enough. And so in 2014, they upped it to 30 days of liquidity. So if you look at, you know, the needs for liquidity, how much money is being withdrawn, then what they said, well, you need to have enough liquidity on your balance sheet to meet, like, for example, 30 days worth of withdrawals and drawdowns from loans and paying of bills. And that was basically, you know, 6 times what they had before, because they were concerned that at 5 days there's simply an insufficient amount of liquidity to actually deal with potential problems. So that's actually quite bigger than it was, but it's still, you know, probably a lot better than it was, but 5 days certainly was not much. Now, how they do that, in terms of how they actually hold this, whether they hold it in terms of, you know, government money market securities, whether they hold it as excess reserves at the central bank and so on, that's up to them, how they do that. They can be quite flexible how they do it, but they have to report it to the APRA, and APRA has to approve the liquidity plan. So it's not just a case of saying, this is what I'm doing. APRA has to actually approve that their plan is sound and say that meets our needs to have the liquidity on the balance sheet. Right, I'm going to end at that point, so if you want to ask any questions, be around for a while, and we'll pick up at Bank Capital next time. Yeah?
You money, this liquidity allowance for this one amount, does it include the payment system, the ESA?
Well, yeah, you can that's very liquid stuff in there. So that would count as liquidity.
So that's a part of the
Part of it. Yeah. Yeah.